For the longest time, you had two completely separate worlds: the super regulated, suit and tie domain of Wall Street, and then the decentralized, code driven universe of cryptocurrency. Well, a landmark event just happened, and a bridge has finally been built between them. And the key to that bridge? It's a financial tool that's changing the whole game: the Bitcoin ETF.
Now, don't just think of this as another boring financial product. This is way bigger. It's like a major piece of infrastructure, a connection point that's letting the immense river of cash from traditional finance flow into the world of digital assets for the very first time, and in a simple, regulated way.
And trust me, this meeting is a huge deal. Historically, large financial institutions, the big players, just couldn't get their hands on Bitcoin directly. It was too complicated, way too unregulated, and it just didn't plug into their established systems. This created a massive, uncrossable divide. Okay, so what exactly is this bridge we keep talking about? It's called an ETF, which stands for Exchange Traded Fund. The easiest way to think about it is like a gold ETF. You don't have to go out, buy a physical gold bar, and then figure out where to store it in a vault, right? You just buy a share of the fund that does all that for you. A Bitcoin ETF, it does the exact same thing, but for Bitcoin. And that gets us to the why. Why was this bridge so badly needed in the first place? Well, for the average investor, and especially for the big institutions, getting onto the crypto superhighway was loaded with roadblocks. Man, the old way was, well, it was a real headache. You basically had to become your own bank. You had to set up these digital wallets, you had to manage these long, super complex private keys, and if you lose those, poof, your money is gone. Forever. All of that while trying to navigate this new world of specialized and frankly often unregulated exchanges. It was a massive barrier to entry. So the big question is, how does this ETF fix all that? What's the magic here? How does this new on-ramp actually work? Well, the solution is actually pretty genius in its simplicity. Here's how it works. You've got this big investment fund, right? They go out and buy a ton of actual Bitcoin and they hold onto it securely. Then they offer shares of that fund to investors like you and me. This means you can buy and sell exposure to Bitcoin's price in your normal brokerage account. You profit from its ups and downs without ever having to touch the underlying crypto yourself. And just like that, the benefits are massive. All of a sudden, you've got regulated exposure. The actual Bitcoin is held by institutional-grade custodians, not stuffed under your digital mattress. It fits perfectly into a traditional investment portfolio, your tax reporting gets way simpler, and you get access to all the deep liquidity of major stock exchanges. It pretty much solves every single problem we just talked about. Okay, but here's where we need to pay close attention, because this is super important. Not all Bitcoin ETFs are made the same. The difference between a spot ETF and a futures ETF is one of the most critical things to understand about this whole new market. It sounds complicated, but the difference is actually pretty straightforward. A spot ETF, the one that got everybody so excited, literally holds real Bitcoin in a secure vault. A futures ETF, on the other hand, doesn't. It just holds contracts that are basically bets on what the price of Bitcoin will be at some point in the future. So yeah, it all boils down to what's actually underneath the ETF. With a spot ETF, every dollar you put in forces that fund to go out and buy real Bitcoin. That creates direct demand, real buying pressure on the market. Futures ETFs are more indirect. They're based on contracts used for hedging or speculation. And that's why the launch of spot ETFs was such a massive deal. They create real, tangible demand for Bitcoin itself. So, now that this bridge is built and open for traffic, what we're seeing is, well, it's nothing short of an institutional gold rush. The big money is finally crossing over into the world of crypto. And this isn't just about making it easier to buy. It's about something much bigger, what experts are calling the financialization of digital assets, basically integrating an asset born on the internet into the very heart of the global financial system. And look, this isn't just some wild theory. Check this out. A survey of professional investors, we're talking people who manage over $1 trillion, shows that more than half of them, 53%, are planning to ramp up their crypto ETF investments. The appetite is definitely there. And if you think that's just talk, here's the punchline. It is already happening. This chart shows the growth in ownership by professional investors, the big funds. Just look at that jump. It exploded from just $1.8 billion to over $27 billion in less than a year. The traffic on that bridge is getting seriously heavy. So, what does all this mean for the market? What's the so what here? Well, this new river of institutional cash has the power to reshape just about everything: long-term price trends, how much liquidity is in the market, and even the very nature of Bitcoin's famous boom and bust volatility cycles. We're basically watching a new financial era dawn right before our eyes. But, and this is important, we have to remember that this bridge is a two-way street. It brings a lot of opportunity, but it also brings a whole new set of risks and dynamics to the crypto world. This chart here is absolutely fascinating. It shows the money flowing into and out of these ETFs every single day. These flows have become a huge market signal that everyone watches, but you can literally see how wild the swings are. One day, huge amounts of cash are pouring in. The next, it's pouring right back out. This adds a whole new layer of unpredictability to Bitcoin's price. And yeah, that brings us to the new risks we have to think about. First, instead of Bitcoin being spread out among millions of people, you risk it getting concentrated in the vaults of just a few massive companies. Also, Bitcoin's price might start acting a lot more like the stock market. And like we just saw, these huge swings in ETF money can create a whole new kind of short-term volatility. And this right here is probably the single most important thing to take away from all of this. A Bitcoin ETF is not some magic wand that makes all the risk disappear. It's more like a transformer. It doesn't get rid of the electricity, right? It just changes its form so it can travel through new wires. ETFs take the raw native risk of crypto and just package it differently for a new market. All of this leaves us with a huge and kind of fascinating question for the future. For more than a decade, Bitcoin was the outsider. Now that the suits have a direct line to crypto, are they going to tame Bitcoin and reshape it in their own image? Or is the wild, decentralized spirit of crypto going to sneak across that bridge and change Wall Street forever? I guess we'll just have to wait and see.